There's something a little unusual happening in tech right now, and if you've been paying attention lately, you've probably felt it too. Some of the most popular AI tools are growing very quickly, but at the same time, many of them are still struggling to make money. Meanwhile, companies are spending hundreds of billions of dollars building AI infrastructure. So here's the quiet question underneath all of this, and it's one we should probably take seriously. Are we watching a healthy boom or the early stages of a bubble? And if it is a bubble, what would that actually mean for us? I'll explain this in 3 parts, and if you stay to the third part, that's where everything really comes together. So let's start at the beginning. In late 2022, tools like ChatGPT showed that computers could write, explain, and summarize in ways that felt genuinely useful. That changed how companies thought about software, and maybe even how you thought about it. To understand how fast this happened, just look at adoption. ChatGPT reached about 1 million users in 5 days. It reached about 100 million users in 2 months. Now, compare that to this. Facebook took around 4.5 years to reach 100 million users. Instagram took about 2.5 years. Netflix took over 3 years. So from the very start, this felt different, didn't it? For many executives, this didn't feel like a small upgrade. It felt like a possible platform shift. And that created pressure, because in tech, missing a platform shift can permanently hurt a company's future, and no one wants to be the company that missed it. So investment accelerated. Big companies increased spending. Investors rewarded anything connected to AI. Not because anyone knew exactly how it would all work, but because no one wanted to be the one who ignored it. That's how momentum builds. To make this concrete, imagine you're running a mid-sized software company. Your competitors announce AI-powered features. Their stock goes up. Analysts start asking you on earnings calls about your AI strategy. You don't yet know if AI will increase your profits, but you do know that not having an AI story now looks risky. So what do? You invest not because the math is finished, but because waiting feels more dangerous than acting. And when thousands of companies make that same decision at the same time, investment surges very quickly. This has happened before. In the late 1990s dot-com boom, companies added .com to their names and saw valuations double. Investors poured money into internet startups with no revenue, and sometimes no real product. When that bubble burst, the Nasdaq lost nearly 80% of its value from peak to bottom. Roughly 200,000 tech jobs were wiped out. Trillions of dollars in market value disappeared. The internet didn't die, but the financial expectations collapsed. There's also a geopolitical layer here. Governments increasingly treat AI as strategic infrastructure, similar to energy or semiconductors. That means some investment continues not because it's profitable today, but because leaders don't want to depend on another country tomorrow. And that makes this boom harder to slow down, even if parts of it start to look overheated. Now here's where things get more interesting. AI isn't just software, it's chips, it's electricity, it's data centers, and all of those move more slowly than headlines. A single high-end GPU can cost $25,000 to $40,000. Large data centers use tens or hundreds of thousands of them. Serving AI models costs money every time someone uses them. That's why some companies have said publicly that their most active users cost more to serve than they currently pay. OpenAI charges about $20 per month for Plus and $200 per month for Pro, but compute costs rise with usage, so some heavy users cost more than they generate. So the more successful the product becomes, the more expensive it becomes to operate. That doesn't mean the business is broken, it just means the economics are still being figured out. And this isn't unusual. Early on, companies underprice services to grow adoption and learn how people use them, like cloud, streaming, and mobile apps. But it does mean excitement is running ahead of settled economics. Infrastructure also has limits. Data centers consume massive electricity. Power grids take years to expand. Permits, land, and cooling systems all take time. You can't double physical infrastructure overnight, even if demand suddenly explodes. Then there's the business side. In many companies, AI works best in narrow tasks, summarizing documents, drafting text, helping developers, automating small workflows. These are real gains, but incremental. They save minutes and hours, not entire industries overnight. And that creates another tension. Workers feel anxious about being replaced. Companies feel pressure to invest. But economy-wide productivity hasn't surged in proportion to the hype. So there's a gap between fear, spending, and measured output. And that's another reason the bubble question keeps coming up. There's also a concentration risk. Platform technologies often follow a winner-takes-most pattern. A few companies control the models, the data, the infrastructure, and the distribution. That makes the stakes higher. If you're not one of the winners, you're not just missing upside, you may be losing relevance. So again, we end up with a gap. Expectations are rising quickly, returns are rising more slowly. That gap doesn't mean collapse is coming, but it does mean the system is under pressure. One more thing shapes bubbles, and we often forget about it. Regulation always lags innovation. Markets move first. Rules follow later. That delay allows excess to build before anyone tries to contain it. Bubbles don't burst because people argue about them online. They burst because something changes, usually one of three things. 1. Money becomes tighter. Spending slows when borrowing becomes expensive. 2. Credibility gets shaken. A major failure, lawsuit, or earnings disappointment changes sentiment. 3. Physical or regulatory limits are reached. Growth slows because the system can't expand fast enough. Right now, none of these has fully happened. Money is still flowing. Big tech still has cash. Infrastructure is still being built. So instead of a collapse, what we're really watching is a test. A test of whether real economic value can grow fast enough to justify the financial expectations. The technology is ahead of business models. Infrastructure is ahead of regulation. Expectations are ahead of proof. That doesn't mean expectations are wrong, it just means they haven't been verified yet. Here's the real risk. If expectations grow much faster than results, the adjustment when it comes can be painful. Markets can fall, jobs can be lost, confidence can drop. That's what people mean when they talk about bubbles. But here's the other side. Even when bubbles deflate, the underlying technology usually stays. After the dot-com crash, most startups disappeared, but the internet became essential. After crypto crashes, speculation fades, but blockchains and payments still exist. AI will likely follow the same pattern. Some companies won't survive. Some ideas won't work. Some expectations will turn out to be too optimistic. But the parts that are genuinely useful will remain. They'll quietly become normal. So the better question isn't, is this a bubble? It's this. Which parts of this are temporary excitement and which parts are real, lasting change? Because the hype will fade, but whatever continues to be genuinely useful after that, that's what really matters. Stay tuned and subscribe for more interesting content.